Hi folks, BERK here, and if you tuned out last week, you missed a major move. The S&P 500 just posted its longest winning streak in 20 years, 8 straight-up days. While the media screamed about tariffs and recession, investors who stayed the course just got paid. Let's walk through what happened, and more importantly, what to do next. April was a mess, but May started with a bang. S&P up 2.8%, Dow up 3.1%, NASDAQ up 3.5%. Why? Microsoft and Meta crushed earnings. They're spending billions on AI infrastructure, not someday. Now, Apple beat expectations despite preparing for nearly $1 billion in tariff costs. Amazon beat across the board, but warned in Q2 because of trade noise. This isn't hype. This is earnings. This is execution. If you were an owner, you just got rewarded. The winners and losers for the week reflected real results. Up, Microsoft, Meta, NVDA, Broadcom, Reddit, Eli Lilly. All prove they can lead in an AI-driven world, or medicine, where fundamentals still matter. Down. Due to these temporary interruptions, General Motors pulled guidance, suspended its share buyback, and warned of a $5 billion tariff hit. We hope the buyback is reinstated soon when the stock price is still way below intrinsic value. Supermicro fell 15% after cutting its EPS forecast. Hotels like Hilton and Hyatt and fintech names like Block. Weak guidance, bad results. What does it tell us? This market rewards leadership and dominance and punishes hesitation. The economic news can be characterized as strong enough. April jobs, we added 177,000. Unemployment, still 4.2%. Wage growth, still outpacing inflation. That's a green light. GDP, down 0.3%. But don't overreact. Imports surged ahead of tariffs, and imports subtract from the GDP calculation. If we measure the real economy by excluding the wonky trade numbers, still humming. Sentiment? Terrible. But behavior doesn't match the fear. People are still spending. The Fed? Staying put. There is no need to panic or pivot. Trade remains the wild card. There are no formal US-China talks, but some movement behind the scenes. Nike and Adidas are pushing for exemptions. Like I said, GM is holding back guidance. And Apple is bracing for nearly $1 billion in tariff costs. Still, the market's moving up. Because great companies are adjusting, not waiting. What should you do? Here's the real headline. The stock market rewards discipline. If wealth, as we define it, means freedom from worry about your financial future, then do the following. Number 1, own the future. Microsoft, Meta, NVIDIA. They're not guessing, they're building. Number 2, watch valuation. The S&P trades around 20 times earnings. Pay attention to what you're paying for. Number 3, diversify within equities. Small caps are down over 13% year to date. There's pain and opportunity. Tariff-heavy names? Landmines, yes, but sometimes mispriced. Number 4, hedging isn't our thing, but if it's yours, do it with purpose. Gold and crypto are stabilizing. Coinbase expects 50% subscription growth. Number 5, earnings season isn't over. Ford, Palantir, and Pinterest are up next. Volatility ahead, but volatility is the toll you pay for long-term compounding. This isn't guesswork. This isn't gambling. This is capital flowing to winners. And if you own the right companies, it's flowing to you. You want wealth? Own great businesses or their shares. Everything else is noise. If you like these weekly updates, hit like, subscribe, and the notify bell. Take a look at this video where I describe the coming golden age, not according to Trump, but according to a unique theory by Generations researchers. Want a free portfolio review? Let's talk. Links below. Stay the course. See you next week.